Welcome to episode 32 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Marc Cabrera of Four Corners Capital. Nicholas, I know we were both impressed with Marc. What did you think of the conversation?
Let me highlight two aspects that I really enjoyed. One more strategic and the other tactical. The first item, more strategically, he has had 4 exits, all of them exceeding 10x MOIC. How is this even possible, right? So Marc Cabrera's story is that he started as a banker in 1988. And after doing that for more than 20 years, he had not only developed really strong focus expertise within his vertical, which is healthcare, and specifically there are verticals within healthcare where he's an expert. But in addition to that, he had, of course, developed a nose for value. And that nose for value is something that comes true in our conversation as just him having very strong pattern recognition within his field of expertise here. And so it's really exciting to just see and hear how a true expert behaves and thinks. We asked him, what are your criteria for finding deals that have such incredible outcomes? And interestingly, he actually pointed more towards downside protection and, these were obviously not going to fail, rather than actually focusing on the upside. Even though these had outsized returns, what he talks about is the downside protection and the low risk that he felt going into them. So that taught me a lot just about how he's thinking. And after having done more than 20 years of banking before he did it for his first deal, at this point he's done 35 years of banking, he recently retired, he had developed this intuition and he was able to go into deals as a private investor, as what we now call an independent sponsor, and have such a high success rate. Of course, it's very synergistic to be a banker because you see a lot of situations, you see transactions, you talk to business owners all day, every day, year after year. And so special situations come your way. And so as a way to source deals, being an active banker is actually quite an intriguing position to be in. The other point I wanted to bring up, I asked him, and I'm glad I did, towards the end of the interview, I think it was, I asked him, what should we pay a banker when exiting a deal as an independent sponsor? I know the business brokers and the very, very small deals that you will see often on Biz Buy Sell and in the very, very lower middle market, the business brokers tend to have somewhat higher rates, but he said, and he gave us the numbers, that the percentage commission for a proper banker will range from roughly 1.5% to 3%, depending a little bit on the size. So if it's 100 million enterprise value or more, you're in the lower end of that range. And for the more typical deals that we see in the entry point here with 3 to 5 million of EBITDA, you're probably around 3%, give or take. He also said that frequently you will see a ratcheted staircase where if they perform and get you a higher valuation that they had initially indicated, they'll take a higher percentage so that your interests are truly aligned. So I thought that was a super valuable nugget for all of the independent sponsors out there who are not entering the game, but exiting their platforms.
Yeah, the point about the being a banker and just basically the deal flow that you see. I mean, a lot of this is about deal flow, and bankers are the ones who are sitting in the stream. It reminds me just from real estate land, where some real estate agents and brokers make real estate investments because they're the first ones to see a deal. And, as all these deals pass across their desk, they can just cherry pick the ones that have the most meat on the bone and decide to take them for themselves. So it's really an advantaged position to be in. It's almost surprising that we don't hear about it more. The other thing I'll say about Marc, and this really is a very rich interview. Marc covers a lot of territory and does so very well. He's got such deep industry knowledge. And so often in our world, people are coming to industries with a pretty fresh eye. And when you hear somebody who has 2 decades of experience in an industry, it gives you pause because it's like, wow, this is what real industry expertise looks like. And so many people, so many sponsors and investors are, making moves with far, far, far less expertise. So it's just it's quite a contrast when you consider it that way. Max, what did you think?
I mean, I second everything you guys have said, really. There's fantastic synergies in being a banker and a sponsor, particularly if you're focused on a single industry like healthcare and you've been in it for 30 plus years. You're already in the game. You have more, you're kind of playing inside baseball, really. And like you said, that deal comes across your desk that might not be a perfect fit for a banking process, but it is a perfect fit for an independent sponsor. Well, someone like Marc is in the prime seat to capitalize on that. So it kind of reminds me of the episode we had with Bob Coven, where he's a SaaS banker and has done 3 SaaS independent sponsor deals that have gone very well. It's very similar. It's a powerful combination, being both a banker and a sponsor. Marc discusses the fact that he is not an operator and looks for very strong operators to partner with. I think that's a great acknowledgement of what his strengths are and what they may not be, although I'm sure he's learned to be a pretty good operator after the successes that he's had over the years. But a good call out that he made. I can tell you that I definitely want to see more of Marc's deals in the future when he comes across them from an investment standpoint. I think he's certainly not done, and he's going to be finding a lot of value in the healthcare space in the coming years, and he's on top of where the trends are in healthcare. I think you've got to be extremely careful in healthcare as an investor. If you don't know the space, none of us are healthcare experts, although we do have some great LPs in our network, in our fund, that have great healthcare expertise that can help advise us on some of these investments. We're not the experts ourselves. And as Marc said, there are 50 different industries within healthcare. So there have been many roll-ups that have already occurred. A lot of that is in late innings. There's a lot of regulatory hurdles, reimbursement rates, Medicare. I mean, it's a quasi-governmental industry as it is. So I think you have to have somebody like Marc sponsoring the deal that's got that experience, that can identify value and trends and have an eye for what exit potential looks like. I think you could very quickly go sideways in a healthcare deal if you lack that expertise. So again, I'd love to see more of Marc's deals in the future come our way. But I'd be very hesitant as both an investor and a sponsor in picking a healthcare deal if I didn't have the background and the intimate knowledge that somebody like Marc has.
On the point about industry knowledge, the way that we plug the gaps that we might have is we have a broad base of LPs, and then our LPs, of course, have their own network. So we have at Minds Capital, we have this great ability to identify experts really quickly through our LP base and the people that they know. So while we might not be experts in a deal that we're looking at, we can usually identify one pretty quickly. So, but really, without some sort of expert at the other end of Zoom, you're really flying blind when you're when you hear somebody like Marc talk. You realize how blind so many people are flying when they get into an industry and buy a business there. Well, before we get to the interview, a reminder to all the independent sponsors listening: we are actively investing equity in independent sponsor deals. So if you have a deal that you're working on, please submit it to us. You can get us at deal@mindscapital.co. And if you're interested in investing in Minds Capital as an LP, we have a pre-registration form on our website for accredited investors. So if you are an accredited investor, please go ahead and fill that out. And here is episode 32 of the Minds Capital podcast with Marc Cabrera of Four Corners Capital. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Marc Cabrera lives in Telluride and has worked as a healthcare-focused investment banker since 1988. On the side, Marc has completed 5 deals as an independent sponsor. 4 of those he has exited, all 4 of which generated north of 10x MOIC. One of those actually delivered a 40x return, with Marc himself as the biggest investor. He recently retired from banking and is contemplating the independent sponsor route on a more full-time basis, finally. Marc, welcome to the Minds Capital podcast.
Thank you, Will. Just as you're saying that, I'm thinking maybe I should go back to banking because maybe focusing on this full time will impact the returns, but we can unpack them and maybe you'll have a different perspective.
Well, let's do this, Marc. This record of yours, 4 exits, delivering north of 10x MOIC, while doing it as a side hustle. So give us more color there. How did you do that?
So I can't describe any type of vision or super discipline around it. I'll detour quickly on what I think of as my $50,000 MBA. Back in 2009, I was approached by a friend who was running a large behavioral health division for a private equity-backed platform, and they were looking to basically shut down a therapeutic day school. And this platform was paying an all-in sort of average debt cost in the low teens. And so any operation that wasn't sort of meeting a 15% contribution margin, they were looking to either sell or shut down. And this business was small enough that they really probably didn't want to spend the time to sell it. So he approached me and said, "Hey, would you be interested in buying it?" The cost of that asset was $50,000. This was way back in 2009. $50,000 wasn't a small, sum of change for me at the time, but I figured it's enough I could cover in one good year of banking after taxes. So if I lost it, it'd be worth the experience. Fast forward, we acquired it in 2009. I ended up owning it for 6 years. And what I really learned in that business was everything you probably want to learn about business if you go to grad school, but probably don't, because it's not covered in standard textbooks. It's, yes, you take an accounting course, but do you really cover how to do a journal entry or reconcile a trial balance? So all those things, from benefit design of our medical or health insurance, how to structure your professional and associated insurance programs and all that, and just standard things like, what does your handbook say for employees? So I owned that business for $50,000. 6 years later, I sold it for $50,000. I had underwritten, a low 6-figure sort of annual contribution. And I said I could be a business owner doing this. It turns out over 6 years, we generated 2.7 of EBITDA, which was distributed to myself and my partner. So great learning experience, an even better return. It may have topped the 40x. I don't think that's pure MOIC math, but from my perspective, $50,000 investment, and then I've got pre-tax 2.7 in returns over 6 years was a fantastic deal. So that was my entry into being an independent sponsor, because at that point I basically had learned, okay, this is what it's like to be a business owner and be in the cap table.
Well, how did you have time for this? I mean, I think time management might be as much a key to your story as good returns.
One could argue I didn't have the time. I was very much a full-time investment banker throughout this period. This was a tried and true side hustle. So I would do these things early in the morning. I'd log into the QuickBooks account and look at, the accounting for the past week. I'd schedule calls at the end of the school day. Let's say take a break for myself at 5 p.m., connect with the head of the school. So and then I'd spend a lot of time on the weekends. So I didn't have the time, but it was well worth it. Same as if you're working full time and let's say going to get a master's degree, you just find the time. But
you were also remote, right?
The school was in Central Florida. So, and I was living in Miami at the time. I was head of healthcare at a small boutique advisory firm called Morgan Joseph, which is no longer around today. But yeah, I had a full-time role as a healthcare services banker, doing mostly sell sides, which I'd done most of my career. And you bring up a good point. One of the questions I had for myself was, how often do I need to visit? And two things supported the ultimate decision to not visit very often. One was a lot of visits up front, call it 3 or 4, where I spent most of the time not walking around the school, but sitting down with the head of the school. I had no illusion that I could step in and be CEO or run it. I wouldn't have wanted to. I think it's too great of a risk. I know sometimes independent sponsors will step into a senior management role, and depending on what your background is, I think that can work. For me, I don't believe investment bankers have any business running anything other than a deal. So I had a lot of confidence in the team there. They were, these are folks that are, if you're in healthcare, behavioral health, education, you're to some extent mission driven in your career choice. And so that came across loud and clear. And so I developed a fantastic rapport with the woman who was running the school, and she was my, eyes and ears on the ground. So first year I probably visited once or twice, and then for several years didn't visit at all. And I'm not sure that the senior team there even minded that, right? They don't want the suit showing up walking through the halls.
One of the things, Marc, from our earlier conversations that becomes clear is that you're opportunistic. These opportunities come along and you go after them, but you're not immersed in independent sponsor land. Indeed, you're not even, you wouldn't have even applied that label to yourself at this time. So correct? So the question would be, after that early success, do you think about doing deals that were your owner and a sponsor full time, or not? Because you still don't really quite know it's a thing.
I don't know what to think. When I lived in New York City and I started my career there and spent my first decade there, most of the people I met were institutional, right? Private equity, hedge funds. When I moved to South Florida, I was the odd duck out. I wore the suit and tie to lunch. Everybody else showed up in jeans and a t-shirt, driving the same nice car that I aspired to. And I wondered, what are they doing? And they all owned their own businesses. And I got a very quick real world education that wealth creation happens when you're the owner or on the cap table or in the cap table. And so I thought of that experience, which I called an experiment initially, as experiment with business ownership. That created some, house capital that I could then use to deploy my first more traditional independent sponsor deal, which I did in 2013, next to a very well-performing, one of the best performing kind of small cap PE funds in the country. We bought a primary care practice in South Florida that served Medicaid. And there was definitely some hair on this deal. What I mean by that is, this was at a time that Florida was converting its Medicaid program to mandatory managed care. And so before that, let's say 50% of the members in Florida were insured by a Centene or a United Health. The other 50% were fee-for-service insured directly by the state. The state figured there would be cost efficiency, operational efficiency by deploying that whole program as an outsourced administration to a bunch of commercial payers. And so they did an RFP, and we were buying this business ahead of the RFP. So the risk was, if our provider group was, contracted with Centene, but not United, and United won, we might have had a risk there because we didn't have the contract with the payer. The PE partner that I partnered with, and this is not someone who backs independent sponsors, so I didn't know the term at the time, but we both looked at it and said, there's not a lot of capacity for primary care. All the payers are going to have to come to us. And so we ended up buying the business. I introduced the CEO from my network to take over. And we closed in August of 2013. And between August of 13 and July of 21, when we sold it, we more than tripled membership. We expanded the contract base with all the payers in the state. It was really saying, if we just have a boat, when the tide rises, our boat will rise as well. And that was the sort of investment thesis there. And we generated an 11x return on an $11 million equity check.
I think this highlights another theme to your story, Marc, where your institutional knowledge, because you're so embedded in healthcare, allows you to develop a thesis more quickly, or when you see an opportunity, you can see the opportunity more clearly, as opposed to sponsors who are earlier as sponsors or just don't have the same institutional knowledge, where they kind of bone up on an industry quickly to try to understand and develop a thesis. You had all of that baked in. I mean, at this point in your career, you're well over a decade with healthcare experience, right? By 2015?
Yeah, probably 15 years in, where I had a real sort of individual perspective on, okay, I like this sector, I don't like this sector. I like provider-heavy businesses, I don't like facility-heavy businesses. I like this form of reimbursement, not this form. That's, if you're an independent sponsor and you're 28 years old and you have a deep accounting background, I think that's useful. I think having a focus on a particular sector may give you an advantage. It really is about, as you described, Will, seeing the opportunity in alignment with bigger picture things that are happening. And that, again, that is a little bit in alignment with my DNA. You asked, why not go do it full time? Candidly, I don't have the risk appetite. My view was, if I'm an investment banker, I know I'm going to make in a decent year 6 figures of W-2 income, in a better year, hopefully 7+. And I'd rather take that capital that I know is coming in personally every year and deploy it either with smart managers or ultimately through situations where I was part of that management team. I've been asked a few times to consider joining a fund, and I will confess right now, I get pretty nervous about the prospect of having to deploy capital versus wanting to. It's a big difference.
Well, that again comes back to kind of the opportunism, right? The most of at least the 2 deals we've heard about came across your desk. You're not out there prospecting for deals. Fair characterization?
They came across my desk. I think of it as an investment banker, you're a big, you hopefully, if you're doing your business well, you drag a big net. And to use a fishing analogy, right? Maybe you're going for a certain thing, and then you catch other things.
Yeah.
And I did come to this realization early on that there would be a lot of deals I'd come across, maybe more than, my hit rate on investment banking deals in that net was well below 50%. I mean, for every 10 business owners or PE firms I'd meet with, we'd only end up really considering 1 or 2 to be investment banking opportunities. But there might be another 1 or 2 independent sponsor opportunities. And the one that I just described in the primary care space, that was a business that was looking to, was owned by 2 partners. They were looking to sell. They did not want to take the risk around Florida's Medicaid RFP. And so that was an unusual sell side motivation, but I couldn't have taken this on as a banker to sell it. What institutional private equity firm is going to say, yeah, let's buy this, but by the way, we may not have any clients in 6 months. It's not going to get through committee. Mm-hmm. And so my view was there's a amplified risk profile for a business like that. But the way that the PE partner that I worked with and I looked at it was, let's look at the downside. If we don't land those contracts, can we sell the capacity? And I'm a big believer, and I'm quite risk averse. I want to always focus on what's the downside first. Can I exit if there's a downside scenario that starts to play out?
So you're talking about how you're risk averse and you didn't want to leave behind a really well-paying W-2 job, but you're also highlighting that there are certain synergies between being a banker in that you learn a lot, you see the macro trends, and the fishnet, great analogy, you come across opportunities just by virtue of being a banker. So are there synergies, is that what you're saying, between being a deal maker on the side or having partners that are deal makers and being an investment banker?
I think they're fantastic synergies, Nicholas. I do believe, especially if you're an industry banker, you do it for 5 years, you get to really know an industry. You do it for 15, you should know it cold. And some of the most successful investors I know started life as bankers and, sort of bled across both, the investment domain and the advisory domain. And there are firms that are set up that way, called merchant banks. The interesting thing is a lot of times the merchant banks are for both client and LP, let's say comfort. There's a Chinese wall in between the merchant banking effort and the advisory effort. And so they don't actually get to harness or capitalize on all of those synergies. But for me as an individual doing this as a side hustle, I liked where managed Medicaid was going. I could put my own money at risk there. And I do feel like as an investment banker, your net might be a little bit bigger. A lot of PE firms will rely on intermediaries to send them books. And so really good business development and other sort of deal sourcing partners can look at literally thousands of SIMs a year. But there's a little bit of a artificiality to that channel. It's already polished. It's already engaged. There's a sell-side motivation. I was seeing a lot of things. It was literally just a coffee meeting or a breakfast. Hey, what about this scenario? Is there something to do? Can you sell this business? Is it investable? And so on. So I'm seeing a little bit more of the raw material.
Well, Marc, we've now heard about two of your deals. You joked that your $50,000 deal might actually exceed the value of your 40 bagger. But let's hear about the 40X story.
The 40X story is my favorite, not because of the return, but because of how the deal came together. And there was a lot at stake, risk-wise. I spent 6 months sort of really working full-time to try to land this. So the background of the deal was this. There's at the time that there's a publicly traded company, originally backed by a couple of well-known large cap PE funds. They went public. They made an announcement in early 2015 that they had done a strategic review of their therapeutic foster care business, and they decided they were going to exit 5 or 6 different states. I was alerted to this by a friend of mine, and I approached them very quickly. I read the SEC document, the Form 8K that said this is going to be a discontinued op. I sort of did some rough calculation, figured they had millions of dollars of severance, lease termination costs, and the business was effectively break even. It was in aggregate roughly $50 million of revenue, break even. So I approached them and submitted an LOI. And originally, I think we offered $5 million to buy the business. And I'll fast forward. That LOI was, I think, signed in July of 15. As things evolved between July and later in the year, when we closed on a smaller portion of the business, the licensing of each state as a new provider entity became the challenge. And so we were looking at owning operations in Texas and Louisiana and Illinois. Every state had different licensing requirements. We were setting up a brand new LLC. That was going to be the acquiring vehicle. And what it came down to was I couldn't sort of coordinate the licensing of a brand new entity. You've got to apply and get MPI numbers and different things and certain Medicaid contracts. So we ended up closing on just the acquisition of the North Carolina business in November of 2015. That business was about 19 million of revenue, break even at the time. They had roughly 20 offices serving the state. They were probably the largest therapeutic foster care provider in North Carolina. The other thing we did simultaneous was the seller shut down those other 4 states that we were interested in, one of which was Florida, which is where I lived. And so I went to the seller and I said, look, if you're going to shut it down, can I just make an offer to hire all the employees in Florida? I'll take over the leases. I'll assume all the current liabilities. They said, fine. It was a win for them. They didn't have the severance and other things. And so overnight, we had a 2-state provider business. Florida was a couple million of revenue. I want to say in aggregate close to maybe north of 200 employees, and very similar to that $50,000 MBA story. Within a short period of time, we had to set up brand new accounting system, insurance, health insurance, professional insurance, negotiate new leases. It was a mad dash to effectively take a startup entity and acquire an existing business. And so not that that's terribly unique, even in independent sponsor land, but it was something that, again, I was doing late evenings and weekends.
And you were doing this by yourself? Were you doing this by yourself?
But I was doing this by myself. I had one of my co-investors was a corporate attorney, but there was a team running this business. And that gets to a pretty hard view I've developed about, what are one of the key ingredients. My first deal, as I mentioned, I had brought in the CEO, someone who, turned out just to be an absolute rock star. He ended up growing the business that I was in the cap table on, tripling it in size. He then went on and ended up leading that business for the private equity firm that owned it. And I think they sold it for 2.5x of enterprise value, much in a bigger equity return. That was probably luck as an opportunity and timing as much as anything. But I really believe that there should be someone running the business. And my conviction around the investment thesis in therapeutic foster care, when I heard about the opportunity, I flew to North Carolina. I sat down with this guy I'd never met. Pretty soft-spoken, but very just credible, authentic guy. And I said, why on earth would the owners get rid of this business? And he said, well, let me tell you what's happened in our industry. Specifically North Carolina, the state thought there were too many providers. And so they ratcheted down reimbursement. They tightened up operational and other licensing requirements. We are at the end of a 5-year downturn that was specifically mandated by the state. And it's going to turn around in the next year or two. And we are supremely positioned to pick up that sort of return of the tide. And he was 100% spot on. That's exactly what happened. So I'm not going to misattribute luck here. We caught the falling knife right before it hit the floor. But as it turned out, as we owned the business over the next 6 years, census grew, reimbursement improved every year. Our margins went from basically break even to, I think when we sold it, probably high 3s, low 4s of EBITDA.
Yeah. And I think you were going to make a point about management and working with teams there. Did I miss that point?
That's the point. And this is front and center on a lot of traditional PE material. We want to back, an A team, even if it's in a B business. I really believe that, but I would take it a step further. And for me, it was about developing the trust between myself and the CEO of this business. So, I don't know how traditional PE does it, but for me, it's very much a two-way street. I'm asking him to take some career risk. We staked him with some equity. He ended up doing quite well over the 6-year investment horizon. But I had to trust his take on what was happening in the industry because I didn't know the industry well. And I needed him to trust me that I would be available to take his call on a Saturday morning if something came up, that we would make decisions quickly. There wasn't a lot of sort of fanfare and bureaucracy. And one of the ways that showed up early on was they said their AR was somewhere north of 60 days. And so that's a pretty big working capital investment for a provider heavy business. I said, why is it so long? He said, well, we're in North Carolina. We send all of our invoices, if you will, to Maryland. Maryland then submits them to the state of North Carolina. If something gets rejected, it goes back to Maryland. By the time it comes back to us, it might be 60 days. And by regulation, we don't have the opportunity to resubmit the corrected invoice. That was 60 days. That led to 60 plus days of AR. I said, well, you're going to be an owner of this business. How would you do it? He said, I basically use this brand new electronic medical record system. It submits the invoices weekly directly to North Carolina Medicaid. This business was nearly 100% Medicaid reimbursed. And I said, great, let's do that. We're going to switch everything over. It's going to be painful for a month. Fast forward, within the first quarter, our AR came down to less than 30 days because we were submitting so frequently. And I've seen a lot of very successful provider businesses really focus on that kind of, minute detail of how quickly are we submitting our claims and things like that. But it was, the fact that he proposed the idea and I said, let's go for it. I think that created a level of trust and confidence in each other that we're going to work well together as partners.
Taking a step back on this deal, so you acquired it in 2015, and you said you acquired it as just before it hit the ground as a falling knife. It had 19 million of revenue in North Carolina. You were able to acqui-hire effectively the business in Florida that had another 2 million of revenue.
Correct.
How much did you pay for the North Carolina business?
Well, if you recall, the original LOI to buy all 5 states, and Texas was actually a bigger revenue business, was 5 million. So we ended up paying roughly $1 million for the business. And you might ask yourself, why on earth would someone sell a $20 million business for $1 million? And by the way that deal was structured, it was, we didn't pay the seller $1 million. We committed in the purchase agreement to invest $1 million of equity into the business. So the seller was most concerned of, some scenario where we under equitize the business. It goes under, they're still on the hook for liabilities if we file bankruptcy. And so we effectively got them to contribute capital. We said, we'll contribute equity capital, and that was the deal. But from the corporate seller's perspective, they avoided a big severance write-down, big lease termination write-down, other discontinued operations write-downs. And so if that number was 10 million, that's a $10 million accounting loss that they avoided. And so that does happen pretty frequently with public companies looking to discard unwanted operations.
Yeah, I think we've heard this multiple times, Will, that carve-outs, where there are strategic motivations from a large corporate seller, and the dollar amount is, in a way, secondary to solving the problem of an unwanted divestiture, right? Or wanted divestiture of an unwanted asset, I should say. Okay, and so going back here, Marc, you said that the operator was taking a career risk by partnering up with you because you're a full-time banker, you're sitting in South Florida, he's in North Carolina, he's an operator. But what choice did he really have? What was his option here?
His options were to, and this was an industry that at the time back in 15 was probably sort of rebounding nationally. He's a super talented operator. He had the opportunity to go probably transfer within the larger corporate, go join another provider. Talent in this domain or this niche domain of the mental health or behavioral health space is pretty rare. The fact that he was willing to take the bet said a lot around his confidence in his longer term view about what was happening in the industry. So I do think he had options. I think this was higher risk, higher return opportunity for him. And that obviously turned out to be the case.
And so there's a qualitative element to persuading him, but it sounds like you also incentivized or put a compensation structure in place that gave him some upside and a shot at goal here that he should at least try out for a year or two, right?
100%. We structured an management incentive equity package where he didn't have to put much, if any, capital at risk. We created some hurdles around that. We made him a partner in the deal. And that can be obviously very, very motivating.
Right. And worst case, he tries it out for a year or two, right? And if it doesn't go well, he still has other employment options. Now, in a way, with an even more robust resume.
Absolutely. Without any real capital at risk, he's got his reputational career capital at risk, of course, but no financial capital. And the structure we developed as partners, and this is me putting my money where my mouth is once he bought into his equity through retained compensation, he was a full partner. So if we did a distribution, he directly benefited from that distribution. We didn't have any return hurdles attached to the incentive pool because the reality was for $1 million equity check, you're either going to lose all of it or it's going to be a fantastic return.
Right. So some version of stock options, is that what it was?
No, it was LLC membership interests that were conveyed to him after repaying a loan from the company.
What kind of reporting cadence did you and he have?
We did a monthly accounting review, or I should say sort of KPI and financial review. I was in the QuickBooks account directly, so I could, pop in literally anytime I wanted to and see how things were going. But the cadence was, a week plus into the month, we would get together on a call. Vice President of Finance, him and myself, just go through the prior month, look at things like census KPIs, staffing KPIs, and then the actual performance. Because our AR had come down so much, we had revenue tended to close pretty quickly and not change. And then there were always questions about, okay, we need new PCs or laptops for staff. That's a big CapEx expense. When do we want to do that? The typical things that a board might cover.
And so in this deal, which you were able to acquire for $1 million, at this point, you had quite a bit of distributions from the school that you had acquired in 2009. So you were, if I remember correctly, the lead investor on your own deal here.
I was the lead investor. Yeah, you're spot on. I thought of it as house money, even though I'm not a gambler. But yeah, if you do the math, I was looking at the risk capital is really having come from the school business. We literally, I think, sold the school in the summer of 15, and then I closed on this acquisition November 30th, 15.
Okay, and so you get in, you're able to pretty quickly add on Florida as a new state for further expansion. You set up a good reporting cadence with an operator that you have incentivized, and you address working capital weaknesses. What else happened, and how did the journey go for this deal?
Well, the very first thing that happened was so we closed in November 30 of 2015. So our first month of operation was December of 2015. In our first session of monthly review in January of 2016, we saw this dramatic down drop in revenue. And it was enough that I candidly panicked. I thought this, I didn't catch the knife right before it hit the floor. It's still falling and it's slicing my hand. It turned out that the real issue was the change over to this new electronic medical record system. Everybody was focused, and imagine the scenario, right? These are 200 plus employees, including a management team of, call it 6 or 7. And you have to do everything under the sun that you would if you're being sold, if you're being acquired. So it's changing addresses on, or the name on the business card. It's the website, it's the lease. So I think the team was trying to boil the ocean instead of focusing on the transition to the new rev cycle platform. And so we had a all hands call. Within a couple of weeks, we saw the right trends going back, but that was a very scary moment for all of us. But we put our finger on what the issue was. It was solvable. And then I paid close attention for the next several months. And the first year or two were a little slow in the rebound. If you recall, the CEO had said it might take a couple of years for this to really stabilize. And that's exactly what happened. It took a couple of years. I mean, we were marginally profitable. We didn't have to contribute more capital to the business. We did our first distribution roughly a year later. And so that's significant because, remember, we put roughly $1 million of equity into the business. And we took a little bit of that out, or I took a little bit of that out personally as a deal fee. And then we took out a distribution later in 2016. And so we took some of our bait back off the table. And that was part of the deal we made with the seller, is when we contribute our equity capital, we agree we won't do distributions for, I think it was 6 months minimum.
Marc, this $1 million that you've put in, so a very low entry price, and we're going to hear what the exit was. But are there LPs involved? What's kind of the structure here? Were these typical kind of private equity structured acquisitions?
The structure was probably pretty traditional. So Delaware LLC, I used let's say an operating entity to acquire the assets. We had a topco holdco, which is where my capital sat along with a couple of other smaller partners. I didn't think of them as LPs. I thought of them more as partners since we had direct membership interests in the topco holdco. And then we had an intermediate holding company that we could sell. And the idea was, in healthcare, if I could sell the intermediate holding company, there's no change in control at the operating entity. So that was just a little bit of forethought to the potential exit structure down the road.
And so were you, other than your equity in these acquisitions, was there also a kind of traditional carry piece like there would be for GPs in private equity, in traditional private equity?
There wasn't in the therapeutic foster care business, primarily because the amount of carry would have been on a minority of the capital. And I was really looking at this as an investor would. I'm taking a big risk, committing high 6 figures to this. If it worked out, it was going to work out well. So no carry in that one. Candidly, no carry in any of the independent sponsor deals that I've worked on. Which might cause people to stop listening right now. But the truth is, I probably didn't learn about the independent sponsor world and what that title meant, or the fact that there's a large independent sponsor conference every year in Dallas hosted by McGuire Woods. That's a fantastic venue, until very late in my independent sponsor career or side hustle. for me, I really looked at these as opportunities to generate significant alpha because of my perspective on what was happening in healthcare. I did convert a number of these into investment banking clients. And so over the years, I probably generated, 15 million in revenue from representing the sell side. So it was a fantastically symbiotic relationship.
Yeah. Yeah.
And this is the part that's a little embarrassing. You and I met when we were looking at a more recent independent sponsor opportunity. And it was finally in that one that I understood the compelling carry metrics that might be available in the market. And I said, geez, maybe I've been doing is fantastic. And I would never complain as the returns have been. I didn't really get the opportunity to experience the carry aspect firsthand.
So it was when you discovered carry that you decided to go full-time as an independent sponsor?
That was a little bit of coincidence around that I have a good friend who he and I have partnered on a couple things. We're both here in Colorado. And so he's done it the right way. He's got 3 investments today. He's got carry, he's got management fees. And that's enticing. But I will go back to something that I didn't say before, which is what my very first true independent sponsor deal where there was institutional capital next to me. The most compelling thing I could do was go to the sponsor and say, I'm willing to write a check. It's a meaningful check for me. That's me putting my money where my mouth is.
Yeah.
That's an investor first posture as opposed to an independent sponsor first posture.
Yeah. Yeah. Well, of course, skin in the game is what we and everyone looks for in sponsors that we invest in. And that skin in the game can sometimes be lacking. And that's a strike against investing in an independent sponsor deal. Your posture was always a lot of skin. So whatever partners you were recruiting to participate with you in whatever deal you were working on, sure felt confidence that it really mattered to you.
They were smart partners for sure. And that was part of the beauty for me as an independent sponsor was, yes, I didn't get carry or promote, but I also got to lean on, in one case, a really, really like world-class investment firm and partner.
Okay, so you bought the business for $1 million in 2015. We've heard a little bit about the journey. Can you tell us a little bit about when and how you exited?
Yeah, that was really where I would say market timing, which is not something I ever feel like I can predict, and I casually refer to as luck, really helped the ultimate return. But if you recall, 2020, of course, was COVID, and markets shut down late Q1, all of Q2 of 20. Things really started to pick back up in Q3 and late Q4. I know just one of the metrics I focused on was how busy is the investment banking team that I'm managing. And 20 ended up being a very busy year. And as we headed into 21, it looked like it was going to be a monster year. And so in early 21, I called the CEO on a weekend. I said, hey, I think we should consider exploring an exit. He agreed. The business was doing really well. We had some unique, at the time we were, I think we had wrapped up 2020 north of 3 million of EBITDA. We were implementing or had implemented a couple of risk sharing mechanisms with our Medicaid payers, and those were starting to show up as revenue. And so there were a lot of things to point to in the KPIs and financial performance of the business that we were proud of. The other thing was throughout this entire period, we had looked at roughly 25 acquisitions, ranging in size from $500,000 of revenue to a couple million, and they all wanted prices of 5, 6, 7 times EBITDA. And we said if they're getting multiples like that, and many of them were, maybe we're worth 8 times. And so Of course, 8 times 3, you do the math quickly and you go, that's a fantastic return. Fast forward in Q2, we interviewed 3 bankers. For a very brief minute, I considered whether the firm I worked for, Oppenheimer, should assign a sell-side team and take it on. And I just thought there would be, too many conflicts and the temptation for me to drink my own Kool-Aid there. So I said, let me interview 3 firms that I think really know the space. Because I was really a physician-focused banker, and the 3 firms I interviewed really focused on behavioral health. We ended up hiring Capstone, a team out of Philly that really knew the space. They gave us a very compelling pitch around buyers and process. Interestingly, all 3 bankers suggested a median valuation of around 8 times EBITDA. So we kicked off the process formally in the summer of 2021. And again, I'll highlight this because I do think it's a little bit of the fun fact around this. I'm doing this on nights and weekends. So when we wanted to go through the pitch deck, it's like, all right, guys, I hate to do this. Can we do the call Saturday morning? Let's flip pages. We did hire Cohen Resnick to do a QV, sell-side QV. We hired one of the consultancies to do a industry study around coding and trends. So we had a very traditional sell-side package. I think we entered market in August of 2021, got IOIs in September. And I remember the day we got IOIs because I lived this day many times as a sell-side banker. As an investment banker, I've probably closed 150 or 160 deals. And there's always the day that you expect your PE buyer community to show up with their indications of interest. And it's always a little nerve-wracking because it's like, all right, my credibility as a banker is a little bit on the line. I told the seller, I think we're going to get this. And so, you can do a distribution curve and see, where are you on, where are you low, where are you high. The day that we were getting IOIs for this business, by 5 p.m. that day, I think 2 had come in. And I started to get a little nervous, like maybe the timing isn't right. Maybe I miscalled this. I didn't really blame the banker. I knew the banker had done a fantastic job. Fast forward a day later, we ended up getting probably closer to 12. A bunch of folks just submitted late. And the 12, interestingly, came in. There were a number that were, 6 and 7 times, but a good majority of them came in well north of 8 times. And that's when we started to get more confident that something could be done. Fast forward, we ended up negotiating really with 3 buyers. 2 were private equity-backed platforms. One was a private equity firm. And interestingly, the private equity firm had the highest bid. And I talked to the CEO who, again, he was now a full-fledged equity partner in this. And I said, look, I know the firm, I know the partner, they're good folks, but let me tell you why that might be a little bit more risky. Private equity firm isn't an owner in the business, doesn't know the operations. They want to get in diligence. They might find something midway or late in process and decide that they actually don't want to invest. If we take the second highest bid, which is backed by an operator, there's a lower risk that the deal doesn't fall apart in diligence. And so that's the decision we made. We left money on the table. It was the right move. We ended up closing late December of 2021 at a price of around 46, 47 million as an enterprise value.
Wow. And so, because your EBITDA had evolved a little bit further from the 3 million number at the beginning of the year also, right?
It did. So we did a QV that captured part of the performance in 21. So I think we were marketing, actual trailing EBITDA, call it 3.8, high 3s, and then pro forma adjusted for full year in the low 4s. And so the multiple ended up being calculated somewhere between 10 and 11 times.
And so this is a situation where you bought the company in late 2015 for 1 million. You were able to make distributions and dividends within the first 12 months, probably making up a lot of that initial investment early on. And then you exit well into the $40 million range 6 years later at the end of 2021.
Those are the numbers.
And when I asked you to attribute this success to key factors, you brought up the word luck the other day. Why did you do that?
It would be far too tempting to say, hey, look at this return. I'm a great investor. The reality is, I would say we took a little bit of outside risk at the front end, but we made up for it in purchase price. And, imagine if we had paid $5 million for the business, right? The MOIC would have dropped from 40 plus to still, less than, 8 times, let's say, but which is still a handsome return. But that was a supremely risky deal up front. It could have easily BK'd within the first couple of quarters. The part of luck that I would say is, ending up sort of trusting the view that we were buying a cyclical trend in the space. We saw it play out in nationally as therapeutic foster care started to grow nationally in census, and national Medicaid payers started paying good reimbursement for the service. I think a lot of the luck, Nicholas, was hitting the market in 2021. That ended up being a record year for just about everybody. We were a little late. We wanted to use a rep and warranty insurance policy as a sell side. And when we contacted, some of the carriers in Q3 of 21, they said, sorry, we're booked through the end of the year. If you want to close your deal this year with a policy, we can't underwrite it for you. They were that busy and sort of so we ended up putting, I think, 10% of the proceeds into general escrow for 12 months. And we got that fully released. But it just gives you a sense of how stacked activity was that year. In my own banking business, this was another corroborating fact. It was my absolute record year in terms of investment banking revenue in a 30 plus year career. So the firm I worked with had record earnings that year. Our group had record, revenue. And so it was just that, really, thinking that it's going to be a big wave, to use a surfing analogy, let's put our board in the water and not realizing how big of a wave it was going to be.
Amazing. Thank you for sharing that. Marc, you said that you selected Capstone as your exit advisor on this deal, and they obviously delivered very well. You chose them over your own firm and team because of conflicts. Do you, as a long-term banker since 1988 and 4 or 5 times exited independent sponsor, what are your best practices around selecting an investment banker?
I'm a big believer that the banker should know the space you're selling into. Back in the late 2000s, the firm I was at, we hired a consulting firm that essentially did a survey of call it 50 different private equity firms, and they said, what's the most important criteria in terms of selecting a banker? And number one criteria by far was industry knowledge of that banker around the space that you're selling into. I think that is a little generic and aspirational. The reality is, I think there is a little bit of a symbiosis between some of the heavy sell-side firms and the more active mid-market PE buyers. The quid pro quo, if you will, is, hey, if we show you X number of deals, and by the way, the PE firm tracks that number of deals, we're going to get a shot at selling X number of your portfolio companies. And I think that's fine. That system works really well. I didn't ever work at a firm that had the deal flow to be able to sort of get on that ranking. And so we had to show up with industry knowledge. And so over my career, we ended up developing really deep insights into a couple of core areas, including value-based care, primary care, physician services. And that was really the reputation we had from an industry knowledge perspective. I had really not a ton of experience in behavioral health, which is where this 40X platform was sold. And so Capstone, the bankers at Capstone really demonstrated deep knowledge. I did not care what their valuation said. At a $1 million investment, you could have told me it's 6 times. You're incentivized to get the best price. If you end up delivering 8 times, fantastic. I'm still very happy as an investor. And I think that is where this dynamic has haunted me throughout my career. And it's one of the reasons I probably enjoyed leaving the sell side. There is the game of, hey, we can get you 20% more. Let's win the assignment. And then, oh, by the way, now that bids are in, it's actually not 20% more. It's what the other bankers have said. And I've had assignments come back to me because of other bankers overpromising valuation. So it is really, do you know the buyers? Do you talk to them? What are the dynamics that you can speak to that are going to influence valuation, diligence, closing certainty? And my team at Oppenheimer, the best team I've ever worked with, we didn't have that knowledge. And so the conflict was maybe a bit more of an excuse, but Capstone really earned the assignment given their industry expertise.
How big of a role does pricing play in selecting a banker? And can you also tell us what pricing should be for typical lower middle market deals when you're exiting?
Pricing should be tied to, I mean, we got 3 pitches, we got 3 proposals. They were all quite similar. In my mid-market practice, rough numbers, right? A $100 million enterprise value sell side might be priced at 2 to 2.5%. 300 million might be, 1.5. Like, I don't think the pricing varies dramatically. I've never lost a piece of business over pricing, but I never wanted to win one based on pricing either. In the case of the lower middle market, the fees start a little higher. They might start at 3%. We ended up, Capstone earned, I can't do the math in my head, but it was a very healthy fee because of ratchets that we had instilled. So we had kind of their base pricing was at 8 times. And so, at 9.5 times, and then at, 10.5 times, there were bonuses, and they earned those bonuses. And I think they were pretty pleased with the fee that they earned. It was, well north of $1.5 million.
Yeah. And you mentioned that they demonstrated knowledge, but in a space like healthcare, I would imagine there are a lot of bankers who knows healthcare really well. So how do you distill that side of it? Is that a little bit more wishy-washy and ambiguous, or are there particular and tactical things you can do to really find the best one?
It's so healthcare. Here's the misnomer of healthcare. Healthcare is not one industry; it's 50 industries, and it really is. I mean, and I've experienced this personally in terms of areas that I've covered. And we've seen a proliferation of specialization. So the analogy I always use is 100 years ago, there were maybe 20 specialties in medicine. Today, there's over 130 different specialty societies. You've seen the same thing in healthcare. So there are bankers that only cover adult daycare, and there are bankers that only cover clinical trials and pharma. I was a banker that covered mostly primary care, but when I went to pitch specialties, a really smart sponsor would say, okay, Mark, you've done a lot in primary care. How does that translate into your ability to execute well on a specialty physician sell side? And so if you're an owner in the business, you're going to know that business better than the banker will. You may not know the industry as well, right? That's where you may sort of collaborate with the sell side banker. But if they know that space well, I think that's going to be self-evident in the pitch. And conversely, if they don't know it well, that's also going to be self-evident in the pitch.
And so you mentioned how the market peaked in 2021, or at least was at an all-time record high then. How has it evolved since then? And how should independent sponsors today view the healthcare space, or the 50 industries that aggregate to be the healthcare space?
Great question, Nicholas. So 21 was a record in terms of, and I'm going to focus on sort of PE acquisition activity. It was a record in terms of both volume of deal activity and valuations. Fast forward into 22, the first half of 22 saw some of that deal flow that didn't close by December 31st, 21 bleed over. But we have gone from an absolute bounty in 20 and 21 to a pretty severe drought over the last number of years. And so I know in our business, we focused a lot on value-based care. That covers everything from, health insurance plans like Medicare Advantage, all the way to primary care and a lot of different coding and revenue cycle providers. In 22, Medicare changed a number of the rules around how value-based providers are reimbursed. They essentially cut out a lot of the margin. This was very intentional. There's an argument that Medicare made, and I think it's legitimate, that they overfunded the profitability side of value-based care between 2014, 15, all the way up through 21. That decimated a lot of the high-performing providers in the space, and some of those are still struggling today here in 2025. So think about that. If the typical investment horizon for a mid-market sponsor is 3 years, if you bought a value-based care business in 20 or 21, you're probably still owning, you still probably have ownership of that. So you're already at 50% beyond your typical median investment horizon. I've had industry experts tell me that particular category of healthcare won't really return to profitability until 28. When I look at the healthcare landscape, the big buckets are provider consolidation. What we saw the most of, in the 2010s was physician consolidation. There's roughly 1 million licensed physicians in the US, a third in primary care, a third in specialties, office-based specialties, and a third in hospital-based specialties. The hospital-based specialties got consolidated in the 2000s. The primary care and office-based got consolidated in the 2010s. When I left banking in 24, there were over 300 private equity-backed primary care and office-based specialty platforms. The median hold time for that cohort was north of 5 years. There is no natural corporate buyer for those assets. And so when folks come to me today and say, hey, what about, acquiring a GI practice or acquiring this? It's a very quick but polite no. The macro trends in that space aren't conducive to an exit. There's no natural corporate buyer. The same thing in, call it, facility heavy-based businesses, where you've seen interest rates come up, which impact your real estate cost. That part of the business in healthcare, hospitals, things that, require big, expensive facilities, right? Your cost of real estate just went up as a result of the interest rate spike. The area that I really like today is behavioral health. If you look at national stats in mental health, whether it's prevalence of anxiety, depression, things like that, they're at record highs. I think there was a stair-step elevation post-COVID. We're seeing it throughout, socioeconomic class, ethnic class, kids. And so the deal that we of course met on was a adolescent-focused inpatient behavioral health business. It's a business that is a very tough business. It serves a very clinically challenging patient population, but it is a space that today, unfortunately, doesn't have enough beds nationally. That was a very significant tailwind, in my view, in that space. So healthcare has gotten tougher to invest in. Behavioral health, I think, is still a bright spot.
Great, Marc. So behavioral health, favorable supply-demand imbalance there from the perspective of independent sponsors. What else can you say? Are there particular segments within that space? Just would love to double click on your observation.
Yeah, great question, Will, because I do think especially what really is any investor, but as an independent sponsor, right? Part of your job, part of my job is always to tease out the sort of macro dynamics against the deal dynamics. And behavioral health, I think, has had a very nice tailwind because, as you mentioned, nice macro tailwinds. It's just demand for service has outstripped the development of supply of providers. Behavioral health as an industry is a $100 billion plus industry. 20% of that is focused on substance use disorder, so drug, alcohol. Think of your inpatient 28-day stay, inpatient facility, your detox, your methadone clinics, things like that. I'm a little less bullish on that space because there was a buildup of facility infrastructure in the 2010s. It's a tough patient population. The data around sort of relapse is pretty discouraging. The other 80% is the more traditional behavioral health. So that could be talk therapy to work on anxiety, depression, some of the more headline conditions that people deal with. And that is, an $80 billion industry. And a lot of it is based on office-based, school-based, telehealth-based provider interaction. So it's similar to the business that we own in therapeutic foster care. It's a staffing matrix, staffing metric heavy business, easy to manage from that perspective. You can, I think, tweak the revenue cycle. And so I like that space a lot. I think there's a multi-decade tailwind driving that space. Consolidation tends to be pretty easier, consolidating offices and providers. The challenge really tends to be a lot of times, and I've talked to a number of other independent sponsors about this, is entry price. So you find a $3 million practice doing $600,000 of EBITDA. It's owned by a psychologist or a psychiatrist, so there may be a medical or prescription component to that business. If that psychiatrist is looking to sell that for 8 times, that's a quick no for me. 8 times or 10 times is my exit. You need to be able to buy that business for 3 times. There's enough risk in terms of doing your next add-on, setting up all the infrastructure you'd want to have once you go back to sell the asset, right? You want to sell a platform. You don't want to sell a collection of practices. And so entry price, I have found, tends to be the biggest or most formidable gate in getting into the space. There are so many businesses I've seen that have less than $1 million of EBITDA that want, somewhere between 5 and 10 times as an entry price.
And Marc, wouldn't that be an indication that the space is already overheated?
It would be an indication that, it's an indication of a couple things. So the first sort of, let's say, double click to test that market metric is, okay, if the $1 million EBITDA business wants 8 times, what is the $18 million EBITDA business getting? And that's when, I would reach out to some of the bankers that cover behavioral and I'd say, where are the big PE-backed assets trading? And if it's, they're trading at, 11 to 12 times or 11 to 13 times, I don't think that's enough arbitrage opportunity. I've seen this dynamic many times where the add-on market is overheated, but the mid-market platform market is more rational. And the smaller tuck-ins are often represented by business brokers, maybe smaller boutiques. And I think the price discipline is a little different on the seller side there, right? And if you think about the dynamic, the psychiatrist who says, I've been doing this, owned this practice for 20 years, it's my retirement vehicle, getting $3 million versus $1.8 million has a absolutely real world impact on the quality of my retirement. And so the pricing discipline sort of goes out the door because it's mostly about personal objective.
What is the right amount of multiple arbitrage that you would be looking for?
I'd really love to see more than a double. I'd let if the sell side is really at 12 times, I'd love to be in at 4 to 5 times.
What about longevity-based healthcare? This seems to be all the rage this day and age, and you see more and more clinics pop up that service that need or that demand. Well, what are you seeing there? Is that in the early innings, would you say?
I think it's multiple sports, multiple eras playing at the same time. So there are longevity-based businesses that have been around for 10, 15 years that might be heavily oriented towards hormone replacement as a product subset. There might be newer ones that are a little bit more focused on personalized medicine and some more advanced diagnostics. The reality is the clinical data around correlating some of the practices you can sell in a clinic and outcome is pretty weak. And so what you're really talking about, Nicholas, is enhanced primary care or preventative care. And I have sampled more than a handful of different providers. So I was a client for MD-VIP, which was a Summit-backed concierge practice for many years in Miami. My provider retired. I went to a more boutique one. The annual fees range from $1,000 to today. I've seen models that charge north of $25,000 for an individual. And the reality is that what you're getting is time, attention, and maybe a fancier waiting room and a fancier report. But the lab tests, VO2 max test, body scan for body comp, all those things, you can get those things pretty cheaply and pretty basically. And it's really about sort of your own personal health practices. And the reason I say that is if you look at it as a model, can I create a business that charges $20,000 per year for a high net worth individual to be in my practice? Absolutely, you can. And there are a couple of PE-backed platforms that do exactly that. The question is, what's the average tenure of that client? What's the stickiness? What's the turnover and churn? And there's nobody has to sign up for $20,000 practice. I don't like that part of the business.
Great, Marc. Well, we got to start closing the interview here and let you go. This has been really an expansive interview, so thank you for that. As you reflect on these incredible returns that you've seen across your 4 deals, you still have one that you haven't exited, but 4 exited. Anything to generalize about your successes there and the returns you've generated?
I love this question, Will, because I haven't done 50 investments, right? I've done a handful, so I don't know if they're even statistically relevant in terms of a sample set. They are for me, of course. I'm the N of 1. But I have thought many times about how do you codify the approach? What is it that I could point to? And I would say it's a couple things. I think, and I learned this from real estate investors, you make your return on the acquisition, not on the sale. And so the price you pay is, I think, highly correlated with the risk profile you sort of take on and the upside. So I never really think about the return first. I really think about what's the downside. So what is my entry price in terms of a multiple? Why is that important? If I can buy something at 4 times, I don't care what industry it's in, I've got a 4-year window to possibly earn that back through EBITDA. Now, there's obviously some tax leakage there, but that's a very different risk profile than buying something at 8 times. That just, that's almost a decade you've got to wait to get your bait back if you can't sell, if something goes wrong, if there's a hiccup that sort of extends your ability to sell. So entry price is supremely important to me. Number 2 is downside. Like if things don't work, the CEO turns out not to be the horse to back, can you sell this thing? Like what is your ability to sort of exit your illiquid position? Only after that do I then want to start to think about what's the upside and what are the levers I have to be able to pull to generate the upside. A good upper quartile mid-market fund is maybe, the metrics I've always relied on are if you can hit 5 times in 3 years, that's a fantastic home run. If it's 3 turns in 5 years, that's kind of, above average, but still respectable. I think of that as being an asset management sort of bar versus independent sponsor bar, right? Independent sponsor, you have the opportunity, I've since learned, for carry and promote all those wonderful things. But I do feel like you have to have the discipline on the price going in and then really assessing risk. And I think, there's probably a temptation as an independent sponsor, given how compelling the carry and promote metrics in economics can be, to maybe get a little loose around the risk assessment. I won't do that even if I'm writing a check for $500,000 or $1 million. Maybe the difference to me personally today is different than it would have been a dozen years ago, but it's still a very big check. And I think I never personally want to lose the investor lens. I want to start with that. And I think good investors really look at risk first and balance that against return. And that is not the discussion that happens in financial services. It's always return first. Maybe we talk about risk.
Well, and it is a little counterintuitive, because you would think that outsized returns are accompanied by a more risk-on sponsor or investor. And you're leading, actually, with conservatism and leading with downside protection.
You can also look at it as one of the funds that I later became an LP in is Sun Capital, right? And Sun started as a pledge fund in the late, I want to say sometime in the 90s. And their approach was small equity bets with asynchronous return upside. So they would find businesses that were underperforming. They'd figure out where should industry performing be. And so I like that approach because I think there's a lot of merit to skewing the return or the alpha to the upside. If you're doing it with and saying, I'm going to deploy capital across 6 deals, you probably achieved, statistical diversification. Maybe it's 8 deals. So if you're an independent sponsor, you say, I'm going to do this for 5 years. I'm going to try to create a portfolio of 6 to 8 deals. And they're going to have a little bit more risk. But I'm going to make up for it in terms of, the portfolio perspective. That's great. But remember now, are you using the same LPs to back each one? Because every backer might be different. And so the backer is always looking at the risk of your specific deal.
Yeah.
And so diversification gets a little harder execution-wise there.
Marc, I'm surprised in your answer you haven't mentioned industry expertise, recognizing that healthcare, as you put it, is a 50 industry. So it's too big a bucket to consider a single industry. Still, a clear theme here is your deep institutional knowledge of the sub-industries that or the industries within healthcare that you know. Is that not a big contributor to alpha?
It has been for me. Maybe something that I take for granted at this point. Where, interestingly, what has happened because I know the industry so well is most things are quick no's, and that's become a little discouraging at times as I look at things. I've been looking at a number of deals, full time now at this point, and there's a lot that to me are quick passes either because I don't like the space, I don't like the entry price, but industry expertise, I think, will always give you a leg up. Whether it's, hey, I used to own a HVAC business and I'm going to look to do it again. You have a leg up on everybody else in that space. Where I think you get challenged with industry expertise is, I love provider businesses. So electrical contractors, plumbing, HVAC. You find a geography that's growing. You can grow those businesses. I just don't have the conviction around it because I don't know the space as well.
Great. Well, Marc, we got to let you go, but you sure seem like somebody we'd love to have back. So thank you for giving us so much time today. We went over because this was such a great interview. So we really thank you for the time, Marc Cabrera. And again, at the risk of making you self-conscious, wow, those returns. Really congratulations on a part-time independent sponsor career. No pressure. Let's see what you do as a full-time sponsor.
Thank you, Will. Thank you, Nicholas. That is obviously something I'm sort of wading into. I heard there's this thing called carry and promote that you can expose yourself to.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.